Good evening, dear students. Good evening, everyone. Okay, so we have a good number of participants today ready to learn this new topic in our recently started subject of financial management. So we have started with the subject of financial management just a lecture before, and we have completed what sources of funds, right? And now it's time for us to begin with the next topic, which is ratio analysis. Okay. Now, as I said, in this ratio analysis topic, we are going to essentially do a financial health checkup of a company. So, as I have said, um, in ratio analysis, we are going to undertake a financial health checkup of a company, which is essentially going to be the one where we are going to test whether the company is doing good or bad, right? So, if I ask you, let's try to identify a company in which we are going to invest. We're going to make an investment. So, on what grounds are we going to make an investment, guys? On what grounds are we going to make an investment? How do you decide whether to invest in a particular company or not? Yeah, guys. How do you decide? How do you decide whether to invest in a particular company or not? Yeah. On what criteria are you going to take a decision whether to invest in a particular company or not? What factors are you going to consider before you make an investment? Okay. You're going to look at the okay. There's a network disconnection. Okay, so when we are looking at ratio analysis, we are going to definitely analyze certain numbers of the company. What are the things that we are going to, measure about the company? So certain parameters that we are going to look about company is, first we would like to look at how is the liquidity situation of the company. So essentially, when we say liquidity, it simply means we are essentially talking of, when we are looking at liquidity, we are talking of how capable is the company to honor its obligations. how capable the company is to honor its obligation, whether short term or long term, whatever it is. Second part that we are going to essentially look at after liquidity is, we are obviously going to look at something called as the profitability, right? How much profits we are really making, right? Third thing that we are going to use is how active or how efficiently the company is doing its business. So, which is essentially the activity part of it. I mean, how much actively we are using the company's resources, right? And so, of course, we are also going to look at certain ratios which are going to be about the market performance. So it's like how better we are able to manage the company share price, earnings, P ratio. So all those things are going to be taken care of. So these are the broad category of ratios that we are essentially going to discuss in our course of ratio analysis. Okay, so let me just get started with this ratio analysis with the first set of ratios called as the liquidity ratios. Okay, liquidity ratios, which is essentially going to tell us how effectively we are able to manage or how effectively we are able to honor our obligations. Okay. Okay. So let me make you do it with the help of certain numbers. Let's understand these concepts with the help of certain numbers. So first thing, the set of liquidity ratios that we are targeting. The first thing is about current ratio. Okay, current ratio. So the current, before we look into what is this current ratio, let me just take an example. Let's say we have company X and Y. There are two companies. Company X is having a current asset of, let's say, 1 lakh. Company Y is having a current asset of 2 lakh. Now tell me which of these two companies do you feel is in a better position to pay its short-term obligations? Which of companies do you feel is in a better position to pay its short-term obligations? Yeah, guys. Which of these companies do you feel is in a better position to pay its obligations? Is it company A, company B, or which one? Yeah. Which one of these two do you feel is in a better position to, uh, you know, undertake the obligations? I mean, which of these is going to be in a better position to pay its short-term obligation? Why? So I can see most of you are saying why. Yeah. Most of you are saying, but why? Why? But then you know what? This is not exactly the way we are going to answer it. We can't be saying, that a company with a higher current asset is in a better position to honor its obligations. We can't be saying it for a simple reason, because I need to also consider the current liabilities, right? So, for example, if I tell you that if it is 1 lakh and 10 lakhs, so if the numbers are 1 lakh and 10 lakh, guys, The numbers are 1 lakh and 10 lakh. So does it mean that company Y is in a better position to pay its obligation? No, I need to really check what's the current liability. Now let us say the current liabilities that we have are, over here it is 50,000 and here we have 9,50,000. Okay. So we have the net current assets. So net current assets over here is 1 lakh minus 50,000 and here it is 10 lakh minus 9,50,000. Now tell me which of these two companies do you feel is in a better position, or do you feel that both the companies are quite similar, better placed? Do you feel that both the companies are having similar position, I mean similar sort of obligation, or do you feel that any particular company is in a better position? What do you feel? What do you feel, guys? Are both the companies in a similar state, or do you feel that one of the companies is in a more comfortable position? Yeah. Do you feel it's the company Y which is in a better position, or company X, or you feel that both of them are in a similar position? Well, guys, I cannot be looking at this current ratio number. Sorry, I cannot be looking at this current net current assets ratio number, net current assets number, because you understand that even though your net current asset is 50,000, right? Even though your net current asset is 50,000, the relative value of current asset and current liabilities is not same. Like relative values is not same. So like if I ask you over here, what's the current ratio? So current ratio is essentially calculated as current asset upon current liabilities. So over here you have a current asset of 1 lakh, current liability of 50,000. So current asset upon current liability, we get the number as 2. And over here, the number is 1.05. So how do we really interpret this? For this current ratio of 2 and 1.05, how are we going to interpret this? Well, the interpretation is simply going to be current, or I can say like this, for every rupee 1 of current liability, company has rupees 2 of current asset. So for every 1 rupee of current liability, company is having 2 rupees of current assets. Or I can say current asset is double of current liability. So current asset is double of current liability, right? And same way, if I'm looking at company Y, can you tell me what's the position of company Y, guys? What's the stake of company Y? Can I say here, for every 1 rupee of current liability, company is having 1.05 rupees 1.05 of current asset, which means current asset is 1.05 times so current asset is basically 1.05 times of current liability. So where do you feel you are in a better position? For company X or Y, which one do you feel that you are in a better position? Yeah. Of course, it's the company. Where do you feel is a better position? Can I say it's company X, because the company X is going to be having current assets which is double that of current liability. So you are in a much more better position when you're looking at current ratio, guys, right? So you'll be able to honor your short-term obligations in a more better way. So what can we set a rule over here? How are we going to conclude this part? So as a conclusion, first up, we can say higher current ratio right, indicates higher degree of liquidity. So higher current ratio indicates higher degree of liquidity, right? Higher degree of liquidity or higher degree of solvency, if you can also say. Second thing, okay, before I go to the second thing. So one thing is said that higher the current ratio, better is the situation. Suppose if we have another company Z, which is having a current asset of, let's say, 1 crore and current liability is 10 lakh. So your net current asset is above the 90 lakh, but then I say the current ratio over here is 10 lakh divided by 1 lakh, which is 10. So current ratio is going to be 10. Right, guys? So current ratio is going to be 10. So it means for every 1 rupee of current liability, the company is having 10 rupees of current asset. Or you can say current asset is 10 times of current liability. Current asset is 10 times of current liability. So is it a good thing or is it something to worry about? What do you think, guys? Is it a good thing or is it something that you should be worried about? Yeah? Is it a good thing? If your current ratio is 10 times. If your current ratio is 10 times, so is it a good thing or is it something that we need to be worried about? Yeah? So do you feel that now the company Z is a better one? Of course not, guys, because when you have this company Z, okay, high current ratio, when you are having very high current ratio, very high current ratio indicates inefficiencies. So very high current ratio indicates high level of inefficiencies. Now, what are those inefficiencies? First up, it indicates high level of stocks. So high level of stocks indicate selling inefficiency, right? So high level of stock, if you're having good amount of stock, it means you're not able to sell the goods. Same way, what could be the other reason for high level of current ratio? It means you've got high current assets. So why would you like to have a high current assets? Again, it indicates high level of debtors. So high level of debtors indicates you are having a collecting inefficiency or collection inefficiency. So high level of debtors indicates collection inefficiency. Then if we have high level of cash, can you tell me what does this indicate, guys? If you're having a very high level of cash, what does this indicate? It indicates that you're not finding good investment opportunities. So there is investment inefficiency. So there's investment inefficiencies, right? So now the question is, low current ratio is not acceptable. Very high current ratio is also not acceptable because because that indicates high level of inefficiency. Then what should be the level of what should be the level of current ratio that should be considered idle? There has to be somewhere in between. So we say that idle current ratio is equal to 2:1. So ideal current ratio, we generally say that ideal current ratio is going to be 2:1. or optimum current ratio is what we call it as a 2:1, which means for every 1 rupee of current liability, you should be having 2 rupees of current assets, right? Now, if you look at that current ratio, if current ratio is less than 1, it means you are having negative working capital. Negative working capital, which means current asset is less than current liability. So current ratio less than 1, it simply means negative working capital, which is current asset is less than current liabilities. Got it, guys? So current ratio less than 1 means negative working capital. That's your current asset is less than current liabilities. Okay. Now, let's go for the next thing to discuss. Let us say we have current liabilities and current assets. So creditors are amounting to, let's say, 2 lakh. And in current assets, you have cash and bank, let's say 30,000. Then short-term investments, which is suppose 20,000. Then you have debtors to the tune of 1 lakh. And there is a stock of 2 lakh and prepaid expense of 50,000. Okay, so we can see total current asset is 4 lakh and current liability is 2 lakh. So what's the current ratio over here, guys? What's the amount of current ratio? What's the amount of current ratio over here? Yeah. How much is the current ratio, guys? Yeah. How much is the current ratio? It is 2:1, right? So we can say current ratio is 2:1. So is it indicating an ideal situation, optimum situation? Is it indicating an ideal or optimum situation? Yes. Right? It is definitely an ideal situation. But now let us consider a scenario that creditors demand the money. Let us say the creditors demand 2 lakh. Okay. So creditors are demanding, let's say, 2 lakh. Cash and cash equivalent. Of course, we will be using that first to pay the money. So we paid, let's say, 30,000. Let's say we sell the short-term investments. Okay. So we have got certain short-term investments. Suppose we sell it. Okay? So we sell this short-term investments of 20,000. So we are still having, we're having what, 1,50,000 still in our bank, right? Still, we still have to pay 1,50,000 to our creditors. How do I make payment to these creditors now, guys? How do I make the payment to the creditors? Yeah. How do I make the payment to the creditors? How do I make the payment to the creditors, guys? What should be the course of action? Because I have paid out the cash and bank, I have paid out the short-term investment. How do I make it, how do I make the payment to the creditors? Anyone? Loan? No, we're not talking. If you take a loan, your current ratio is also going to change. Let us talk of debtors. Can I ask for money from debtors? Can I ask for money from debtors? Yes or no, guys? Yes. But will the debtors be ready to give? Will the debtors be ready to give? Of course, they will not give the money early, right? They will not be ready to pay the money early because they would be also lacking on the liquidity front, right? But one thing we can do is we can get bills receivable from debtors. So bill receivable discounted or bill receivable from debtors. So let's say debtor amount was 1 lakh, but we were able to realize 98,000. Okay. We were able to realize 98,000 from the debtors. Still, what is the balance to be paid out? What is the balance to be paid out? So out of 1 lakh 50, bills receivable from debtors is 98,000, which is balance to be paid is 52,000, right? So in spite of we having the current ratio of 2:1, we are not in a position, in spite of having current ratio of 2:1, we are not in a position to honor the obligations. Right, guys? In spite of having the current ratio ideal situation 2:1, we are still in a position not to pay our obligations. Now my question is, why is the situation so? Why is it happening? Because our current ratio was 2:1, but when the creditors demanded, we are not in a position to pay them. So why is it so? Why is it happening, guys? Yeah. Can I say there is some problem with the current ratio formula? In this current ratio formula, we consider all the types of current assets. But essentially, if you look at these two type of current assets, these two type of current assets, which is stock and prepaid expense, they are like, non-quick assets. They are, basically non-quick assets. So these are non-quick assets. Now, when you say non-quick assets, you are not in a position to liquidate them into cash easily. You're not in a position to liquidate them into cash easily. Okay. So therefore, there is a need to revise this formula. And therefore, we have a new formula available over here, which is quick ratio, or what we call it as a liquid ratio, or what we call it as acid test ratio. All three of them mean one and the same: the quick ratio, liquid ratio, or acid test ratio. The formula changes as current asset minus stock minus prepaid expense upon current liability. Right? So you're changing the numerator. In the numerator, there were certain assets which were actually non-quick. So in the numerator, there were certain assets which were actually non-quick, and we removed those non-quick assets and considered only the quick assets. And therefore, the name is quick ratio. Then we have absolute liquid ratio, or what we call as cash ratio. Absolute liquid ratio, or what we call as the cash ratio. So here we consider only cash and bank balance, which is cash and cash equivalent, plus any marketable securities, and then you divide it by current liabilities. Cash and cash equivalent plus marketable securities upon current liability. That's your absolute liquid ratio or cash ratio. Okay. Absolute liquid ratio or cash ratio, which is going to be cash and cash equivalent plus marketable securities. That's your cash ratio, guys, right? Absolute liquid ratio or cash ratio. Right. So these two ratios are going to be even more, bit of strictness will come. There will be a bit of strictness over here because you are considering more refined version of it. Okay. Now, let me just do a quick question for you. Let's say the current ratio is, 2. Suppose the current ratio is 2. Okay. And I'm saying that working capital is 3 lakh. Current ratio is 2 and working capital is 3 lakh. So now can you just calculate the amount of current assets and current liabilities? Can you give me the value of current asset and current liabilities here, guys? If I'm giving you the current ratio and working capital. By the way, working capital is simply your current asset minus current liabilities. Just try to calculate this. Give me the value of current asset and current liability, guys. Give me the value of current assets and current liabilities. Calculate and give me. Give me the value of current asset and current liability. Can you calculate it, guys? Calculate the value of current asset and current liability. Yeah, are you able to do it? Okay. Few of you have answered. So 6 lakh and 3 lakh. Well, we can simply say like this, sir, current ratio is current asset upon current liabilities. And we know that this is equal to 2. So essentially current asset is 2 times of current liability. Current asset is 2 times of current liability. Okay. Now, since we know current asset minus current liability is 3 lakh. So now we can say current asset I can be replacing this current asset with the term of 2 current assets. So 2 times of current liability minus current liability is equal to 3 lakh. So 2 times of current liability minus current liability is 2 lakh. So current liability is 3 lakh. So 2 current liability minus current liability is 3 lakh. So we can definitely say current liability is 3 lakh. So what will be the current asset? Current asset is 2 times of current liability, which is 2 into 3 lakh, which is going to be 6 lakh. So we got the current asset to be 6 lakh and current liability to be 3 lakh. right? Now, if I tell you that we have a quick ratio is 1.1. Give me the value of stock, guys. Let me see how many of you can do it. With this same data, with the same amount of data, calculate, I mean, if suppose the quick ratio is 1.1, what will be the value of stock? Assume there is no prepaid expense. Okay, you can just assume no prepaid expense. Just assume there is no prepaid expense. So with that assumption of no prepaid expense, calculate the value of stock. Yeah, guys. Let me see how many of you can get it. Yeah, what's the amount of stock, guys? Calculate the value of stock. Did anyone get the value of stock? Yes, Navneet.
Good evening, sir.
Good evening.
Yes, sir. I write it in the chat box 2,70,000. Sir, my chat is visible or not? I'm not.
No, there are a lot of chats over here, no? So I'm just looking at one by one.
Yes, sir. So actually, I want to confirm that my chat is visible,
No,
or I have.
everyone's chat is visible.
Actually, I'm answering to CA means your two ID, na? They are CA and without CA. So I can answer to anyone.
No, just answer to CID.
Okay, sir. Thank you.
Okay. Okay, so what's the stock, guys? I think few of you have answered. 3 lakh. Well, we can look at this quick ratio. The quick ratio formula is what? Current asset minus stock upon current liability. And this is going to be equal to 1.1. So we know the current asset value. Guys, the current asset value is 6 lakh. 6 lakh minus stock upon current liability of 3 lakh is 1.1. Right? And then what's the value of the stock? What's the value of the stock? What's the value of stock, guys? So 1.1 into 3 lakh. And this is going to be like stock is going to be 6 lakh minus 3 lakh 30. So the value of stock is 6 lakh minus 3 lakh 30,000, which is 2 lakh 70,000. Got it, everyone? Did you get the value of the stock as 2 lakh 70? Yes. Okay, fine. Now, apart from this current ratio, we are also essentially looking at, um, we are looking at the other way around, wherein we would like to know how much capable we are to pay our day-to-day obligations. So for that, let us say there are two persons, A and B. A is having a cash balance of, let's say 1,000. B is having a cash balance of, let's say 700. And the cash expense per day, in case of A, it is 100, and in case of B, it is 35. Now my question is, how many days of cash expense, how many days of cash expense is available as cash balance? So if I ask you with regards to A and B, the cash that is available, that's going to work for how many years? Sorry, how many days? Hmm? So A can survive, A can carry on with how many days? Yeah. In case of A, it is 10 days. And in case of B, it is 20 days, right? So you got this, like A is having 10 days of cash, B is having 20 days of cash. So it's like 1,000 divided by 100 and 700 divided by 35. So 10 days of cash and 20 days of cash, right? Now, which of these two entities do you feel is in a better position or is having a higher degree of liquidity? Yeah, guys. Which of these two is in a better position? Of course, B, right? So here it is less liquid and here it is more liquid, right? So we want to know how many days, with how many days we can function with the available cash. And that's the ratio called as basic defense interval ratio. The basic defense interval ratio is quick assets upon daily operating expense, right? And let's say daily operating expense. Sorry. So how do we calculate daily operating expense? Daily operating expense is your COGS, which is cost of goods sold, plus any administrative expense that you pay, plus any selling expense that you pay. And from this, you will remove the depreciation and non-cash expense, because these are the expenses which you are not going to pay it in cash. And then you divide this by 365. So that's your daily operating expense. The daily operating expense is COGS plus admin expense plus selling minus depreciation and non-cash expenses. Okay, fine. So now, if I tell you, let's say COGS is 50 lakh, admin expense is 10 lakh, selling expense is, let's say, 5 lakh, and the depreciation which is included in this, that is, let's say, 6 lakh. Amortization is, let's say, 3 lakh, and you have got cash and bank as 10 lakh, marketable securities is, let's say, 4 lakh, and let's say receivables that we have is 7 lakh. So calculate the ratio, guys. Basic defense interval ratio. Calculate the basic defense interval ratio. Calculate the basic defense interval ratio, guys. Yeah. So first we need to calculate the daily operating expense. So daily operating expense will be COGS plus admin plus selling minus depreciation and amortization. So that's 56 lakh. And this is going to be divided by 365. So daily operating expense is 15342, and basic defense interval will be cash plus marketable securities plus receivables divided by this daily expense. So we have cash or quick assets sufficient enough to cover for 136.875 days. So you have cash or marketable securities sufficient enough to cover for 136.875 days. Okay. Okay, fine. Now, let us look at some of the long-term liquidity ratios, guys. So let us say we have got two companies, X and Y. We have some information about the equity share capital, preference share capital, reserves, and the amount of debt that they have. Okay, so let's say 10 lakh, 5 lakh, reserves is 15 lakh, and debt is 13 lakh. So we have the total capital employed in the business. As far as company X is concerned, total capital that is employed in the business is 43 lakhs. And similar thing is employed even by Y Limited, wherein Y is having a equity share capital of 7 lakh, reserves of 6 lakh. Sorry, preference share capital of 6 lakh, reserves of 10 lakh, and debt of 20 lakhs. Okay. So these are the balance sheet liability side or the capital employed part. Now, if I ask you, how much is the equity ratio? Okay, so equity ratio is going to indicate proportion of net assets. Proportion of net assets funded by equity shareholders. Okay, so for that, let us do one thing. Let's lay fixed asset over here. It is 30 lakh. And then we have current asset less current liability. So current asset is 20 lakh. Current liability is 7 lakh. So of course the asset is 43 lakh. So now if I ask you, what will be the equity ratio? What's the interpretation of equity ratio? Equity ratio is simply proportion of net assets which is funded by equity shareholders. So proportion of net assets which is funded by equity shareholders. How much is it, guys? What proportion of net assets is funded by equity shareholders, guys? What proportion of net assets is funded by equity shareholders? Yeah. How much proportion of net assets is funded by equity shares? Anyone? For company A and B? Should we take 360? Unless the question specifies, take 365 days. Okay, equity ratio over here. We'll say, what is the value of equity ratio? So this is simply equity shareholders funds divided by net assets. So equity shareholders fund is your share capital plus the reserves. Over here also share capital plus the reserves. And net assets is anyways 43 lakhs. So now the ratio is 25 lakh divided by 43 lakh and 17 lakh divided by 43 lakh. So how do we call this as 0.5814? This is like for rupees 1 of or we can say for rupees 1 of net assets, rupees 0.5814 has come for rupees 1 of net assets. We can say 0.5814 has come from equity shareholders, right? And same way I can say for company Y also that 0.3954 has come from the equity shareholders. So the question that we are essentially trying to answer is, which of these two companies do you find that it is, which of these two companies do you think that it is more uh, solvent in long term? Is it company X or is it company Y? Yeah. So what can you say about the level of long-term solvency is? Level of long-term solvency is high in case of first company and low in case of second company. Okay. Because higher is number, better is the situation. Right? So we got this equity ratio as one of the formula. Then we have debt ratio. Debt ratio is total debt divided by net assets, which is going to tell us what proportion of net assets is funded by borrowings. Right? Proportion net assets is funded by borrowings. So we can get this number as what is the amount of debt over here? 13 lakh and 20 lakh. And the total assets. So we are talking over here the total assets or the net assets basically. The net asset is 43 lakh. So if you look at the proportion, that's 13 lakh divided by 43 lakh. Right? So if I ask you what is the level of long-term solvency again? What is the level of long-term solvency? Of course, lower this debt ratio, better it is. So here we will say high and here we will say low. Okay. So when you say proprietary ratio, sorry, equity ratio, higher the number, better it is. In case of debt ratio, lower the number, better it is. Okay. That's your debt ratio. Then if I ask you proprietary ratio. So proprietary ratio is going to tell us what proportion of net assets is funded by owners. What is the proportion of net assets funded by owners? How much proportion of net assets is funded by owners? Now, how is it going to be different from the equity ratio? Anyone? What proportion of net assets is funded by owners? Yeah. Over here, when you're looking at the proprietary ratio, it's going to be different in a sense that we're now going to consider the preference share capital also. So the formula is going to be like equity shareholders fund plus preference share capital divided by net assets. equity shareholders fund plus preference share capital divided by net assets. Right. So we can say the numbers are going to be equity share capital plus reserves plus preference share capital. Net assets is 43 lakhs and same over here is 23 lakh. So now the proportion is what? 30 lakh upon 43 lakhs and 23 lakh upon 43 lakhs. So again, we say what's the level of short-term solvency? Over here high, and of course this is going to be low. Okay, that's a proprietary ratio. So how is it different from equity ratio? We are going to consider the preference share capital also in this. Okay, guys. Yeah. Now, one more ratio, which is a comparative ratio called as debt equity ratio. Now, as the thing says that debt equity ratio is simply it's the ratio of debt to equity, or you can say of debt. How much is the equity? Right? Ratio of debt to equity, that is for 1 rupee of debt, how much is the equity? So the formula is pretty simple. Debt funds upon equity shareholders funds. So debt funds, we know it is debt funds is what? 13 lakh upon equity shareholders fund is going to be equity share capital plus reserves. Right? So we look at this ratio as 13 lakh divided by 25 lakh and 20 lakh divided by 17 lakh. So of course, higher this ratio, higher is the risk, and therefore lower is going to be the higher is the ratio. It means, the ratio is higher the ratio, higher is the risk, right? So here we can say 0.52 for piece 1 of equity. Okay, for 1 rupee of, this is different, I think. So 1 rupee of equity, how much is the debt? Because it is debt equity, right? So for 1 rupee of debt, there is rupee 0.52. Sorry, for 1 rupee of equity, there is 0.52 of debt. So for every 1 rupee of equity, there is 0.52 of debt. Whereas in the second case, it is for every 1 rupee of equity, there is 1.1765 of debt. So it's having quite high number, right? So therefore, this is indicating a higher level of risk. Okay. So with that, we have covered like the ratios which are long-term solvency, right? So long-term solvency ratios is what we have covered. Now let us just take a break, guys. Okay. Let's take a break, and then after break, we will be going for some more ratios along with some interesting concepts that we are going to look at. Okay, fine. So let's just take a break, guys. We'll meet after a break of 15 minutes. Okay, let's take a break, guys. Let's look for a mini income statement, guys. So let us say we start with sales. Then from that we subtract the variable expense. So we get the value of contribution. Further, we subtract fixed cost. That gives us earning before interest and tax, right? From that, we will subtract the interest, which will give us profit before tax. Further, we subtract the value of tax, and we are left with profit after tax. Further, we subtract the preference dividend, and we get the net profit for equity shareholder. So let us say the sales is 20 lakhs. So making a sale of 20 lakh, right? Okay, 20 lakh less, we are going to subtract the variable cost. Let's say variable cost is 8 lakh. So whatever you have earned from sales, that's 20 lakh. Further, any variable expense, 8 lakh, that will be paid. And the contribution that we have is 20 lakh minus 8 lakh, which is 12 lakh. Then the fixed cost is amounting to, let's say, 4 lakh. So we have EBIT of 12 lakh minus 4 lakh, which is 8 lakh. So this is your earnings before interest and tax. So till earnings before interest and tax, you have not paid any finance expense. Let's say the interest you are paying is 3 lakh and we have a profit before tax of 5 lakh. Let's say the tax that you're paying on it is 30% and you're having a profit after tax of 3 lakh 50,000 and preference dividend is, let's say, 1 lakh 20,000. So the net profit that we are left for is 2 lakh 30,000. Now, one thing typical to note over here is whatever your financials are up to earnings before interest and tax. These are all operational items. Right? So these are your all operational items. It means you have not paid any, finance expenses. Right? And beyond that EBIT figure, whatever things that we have are essentially financing. Right? So how you are doing your business is covered over here in the operational numbers, and how your net profit finally will turn out to be, that's specified in the financing part. Right? So sales, less variable cost, contribution less fixed cost, EBIT, and then you have from interest till net profit for equity shareholders, which is 2,30,000. So that portion is a financing part. So if I ask you, this EBIT, this is actually a earning by the company for, this is earnings for all fund providers. And this is the earnings which is procreated for all fund providers. Right? So earnings for all fund providers, that's your EBIT. Right? Earnings before interest and tax, that's your earnings which you're giving it for all providers. Because when you have EBIT, then only you will be, paying out your interest, then only you'll be paying out the preference dividend. Can you tell me this profit after tax? This is earnings for all owners actually. right? So profit after tax is the earnings for all owners. And finally, this number is earnings. These are earnings for equity shareholders. Earnings for all fund providers, that's your EBIT. Right, so EBIT is earnings for all fund providers. Profit after tax is basically earnings for all your owners. Net profit for equity shareholders is earnings for equity shareholders. Net profit for equity shareholders is earnings for equity shareholders, right? So these are like the income which is generated for different stakeholders. So if you want to calculate the rate of return earned on all funds, then the formula is simply going to be, guys, EBIT upon total capital employed. Right, so EBIT upon what will total capital employed? Total capital employed will be equity share capital plus preference share capital plus reserves plus borrowed funds. So EBIT upon equity share capital plus preference share capital plus reserves plus borrowed funds or debt is what your total capital employed is. Like, on total investment of this much, what is the rate of return that you have earned? That's your return on capital employed. This is called as the return on capital employed. So this is going to be called as a return on capital employed. Same way, if I ask you, what's the rate of return earned on owned funds? Can you tell me what will be the formula for this? Return earned on owned funds. Return that we are earning on owned funds. Yeah. What's the return that's earned on owned funds? Yeah, guys. Return earned on owned funds. So when you look at owned funds, what is the income that we have earned for owned funds? It's your profit after tax. Right? So return that we have earned on owned funds is profit after tax, which is 3 lakh, or we call it as profit after tax. So this is the income that you have earned for owned funds. So profit after tax upon owned funds. So we have the owned funds over here. So, when we just calculate the owned funds, it's going to be PAT upon equity share capital plus preference share capital plus reserves, right? So, and this is called as return on owned funds. Simple. Okay, one more ratio. Let's say if I ask you calculate the rate of return on equity funds. Can you tell me what will be the formula for this? Rate of return on equity funds. Perfect. It's net profit for equity shareholders upon equity shareholders funds. So net profit for equity shareholders upon equity share capital plus reserves, right? And this is what we call as the return on equity. This is what we call it as a return on equity. Now, I'm just giving certain numbers over here. Let's say equity share capital is 10 lakh. Reserves is 2 lakh. Preference share capital is 5 lakh. Debt is 25 lakh. And then we have total capital employed as 42 lakhs. Okay. With these numbers, calculate all the three rate of return that we are talking of, guys. Calculate the rate of return earned on old funds, rate of return earned on own funds, and return on equity funds. Calculate all the three returns, three rate of return, which is return on all funds, which is return on capital employed, return on owned funds, and return on equity funds or return on equity. Yeah, this is going to be EBIT of 8 lakh on total capital employed is 42 lakh. So percentage wise, the rate of return that you're having is 19.04%, right? And the return on owned funds will be profit after tax divided by share capital plus reserves plus preference share capital, right? So that's going to be like PAT of 3 lakh 50 upon share capital plus reserves plus preference share capital. So percentage wise, it is 20.58% or 20.59%. Return on equity that we find is return on equity is going to be net profit for equity shareholders upon equity share capital plus reserves. And this is totaling 23, 2 lakh 30 divided by this 19.17%. Okay, so that's how we compute the various returns in that case. Okay. Now let me just give you an assignment. Assignment means it's a question that we are going to look at. Okay. Let me just give you a question. Let's say I've got two companies, A and B. We have information about share capital, reserves, and debt. And the cost of debt, I mean, the rate of interest is 10%. So let's say equity share capital is 20 lakhs and 10 lakh in case of B. Reserves 10 lakh in both cases. And debt over here is 10 lakh. There's no debt in first case. Okay. So we see that the total capital employed, total funds that has been invested by the company in its business is 30 lakhs, right? So now my question is, we have got a EBIT of, let's say, 2 lakh. EBIT of 2 lakh. So just prepare, I mean, subtract interest then PBT, less any tax. That's going to give you PAT, right? You give me the number of return on equity, just the return on equity and return on capital employed over here. Calculate the return on equity and return on capital employed, guys, for both the companies in the given situation. Yeah. So interest is going to be 10% of the debt. PBT is EBIT minus interest. So less tax is going to be PBT into, let's say, 30% tax rate. And we have PBT minus tax as the PAT number, right? Now return on equity will be, of course, PAT divided by equity share capital plus reserves. So that's what, 4.67%, and here it is 3.5%. Right. So in this situation, which of these two companies is really doing good for its shareholders, guys? What's your opinion? Which of these two companies are, which of these two companies is doing good for its shareholders? Company A, right? Company A is actually performing better, whereas company B is having a lower rate of return. We'll talk about rate of return on capital employed later on. Right now, with these same things, only change is, EBIT. So let's say EBIT is 4 lakh. What's the return on equity now? Just compute the return on equity in this second situation, guys. Compute the return on equity in this second situation. Okay, so now what we observe is that in the second case, company B turns out to be a better one. Right, guys? Company B is better now. Correct? Right? So now my question to you is, why is this thing happening? Why is this thing happening, guys? Yeah. Why is this happening? Funding ratio. B company has paid interest. No. The answer lies in return on capital employed, guys. What's the return on capital employed in both situations? So under both situations, what's the return on capital employed? Hmm? Why is this situation happening? Just look at return on capital employed. Return on capital employed is what? EBIT upon total capital employed. So these are the return on capital employed, 6.67% and 13.33%, right, guys? So if you look at this return on capital employed numbers, 6.67 and 13.33%, just compare it with rate of interest. Here, 6.67% was obviously lower than the rate of interest, right? So here we can say ROC is less than rate of interest. And here we see that return on capital employed is greater than rate of interest. So the idea is simple, that return on capital employed, which is 6.67%, that is lower than what you have promised to pay as a rate of return to your investors. Right? So of course, here, if you're earning 6.67, but you have committed to pay 10%, you're actually paying from your pocket, which means the return of shareholders, return of equity is getting reduced. Return on equity shareholders is getting reduced. Right? Correct. So that's your return on capital employed. So it's going to play a role over here. But when you look at the second situation, 13.33% is your return on capital employed, right? 13.33%, that's the return on capital employed. But what's the rate of interest that you have promised? The rate of interest promised is 10%. So if the rate of interest promised is, 10%, if the rate of interest promised is 10% and you're earning 13.33, it means you have done a good job. Right? So this simply means you have done a good job because you're able to attain a rate of return which is more than the cost of capital. I mean, you have promised someone 10%, but on their money, you're actually able to generate a return which is higher than what you have promised them. Now, that is definitely going to provide you with a higher rate of return. Right? That is definitely going to provide you with a higher rate of return. Okay. So therefore, we say that over here, the return on capital employed is going to play a role. So when do we say that the rate of interest, I mean, borrowing is a good thing? When do we say that borrowing is essentially a very good thing? We'll say that borrowing is good if your interest rate is less than, right? So we can say the borrowing rate is a good thing. Borrowing is a good thing if interest rate is lesser than the return on capital employed. So in that situation, the shareholders are going to be having a better position. Okay. So over here, we come to a next ratio called as capital gearing ratio. So capital gearing ratio is simply funds requiring fixed rate of return upon funds not requiring fixed rate of return. Now, which are the type of funds that require a fixed rate of return, guys? Which are the types of funds which require a fixed rate of return? Which are the types of funds that will require a fixed rate of return? Can I say all your debt plus preference share capital? These are the two types of funds which require a fixed rate of return upon equity share capital plus reserves. Now, higher this capital gearing ratio, means higher capital gearing ratio means higher risk for company. It means high risk for company. High capital gearing ratio means high risk for the company, guys. Right. So this is like again a type of liquidity, long-term liquidity ratio. Higher capital gearing ratio indicates higher level of risk, guys. Are we clear, everyone? Yeah. Now, apart from just the relative position or relative numbers, apart from purely relative numbers with regards to the debt and equity or other types of funds, we would also like to have a look at a situation how capable we are to pay the obligations. So, how to check capability to pay obligations. So for that, let me just take you an example. Let's say Mr. R and Mr. P. Income of Mr. R is 1,20,000 and that of Mr. P is 90,000. EMI of Mr. R is 30,000. EMI of Mr. P is, let's say, 15,000. Now, if I ask you, out of these two companies, these two persons, which one is more capable of paying the EMI? Yeah. Guys, which of these two persons are capable or more capable of paying the EMIs? Yeah. So for that, let us calculate how many times of EMI is income. So you want to know how many times of the EMI is income. So how many times of EMI is income, guys? So we can see over here, R is having an income of 1,20,000 against 30,000. So it is 4 and P it is going to be 6. So it is 4 and 6. That's your times of EMI that we have. 4 and 6, right? So we are having this as how many times of EMI is income? Basically 4 and 6, right? So essentially to look into how capable you are to pay your EMI or pay your obligation, we need to look at this number of times. And this is going to be, coverage ratios. Or to put it the other way around, here, R's income was covering EMI to the extent of 4 times. P's income was covering EMI to the extent of 6 times. Right? So coverage, income is able to cover 6 EMIs, you can say. This income is able to cover 6 EMIs. This income is able to cover 4 EMIs. So in this way, we are going to compute certain coverage ratios, guys. So we're going to look at certain coverage ratios, which will be telling us, which ones are the numbers. I mean, the coverage ratio is basically which ones are the numbers which are going to tell us how capable we are when we want to check the capability of us to pay the obligations. Okay, so there are certain coverage ratio that we are going to look at right now. So let me just show it to you. Yeah, we're looking at the certain coverage ratio. The first coverage ratio that we are looking at is interest coverage ratio. Okay, so interest coverage ratio is, guys, EBIT upon interest. So this is going to tell you how many times of interest is EBIT. So interest coverage ratio is EBIT upon interest, which is essentially how many times of interest is going to be EBIT. Okay, so all these coverage ratios, remember, all these coverage ratios are indicating higher the better. So whichever coverage ratio we're looking at, higher the number, better it is, because better capability you have to pay your obligation on time. Okay, so that's your interest coverage ratio, which is EBIT upon interest, is going to tell us how many times of interest is EBIT. Any idea, guys, what will be preference dividend coverage ratio? What's preference dividend coverage ratio, guys? Any idea? What's preference dividend coverage ratio? Preference dividend coverage ratio, anyone, guys? Okay, PAT upon preference dividend. Perfect, guys. So PAT divided by preference dividend. So this is going to tell us how many times of preference dividend is profit after tax. Okay. Now here we were just looking at preference dividend coverage ratio. We're just looking at whether we are able to pay interest or preference dividend. But remember, when we're taking loan, we are not taking loan only to pay interest. We need to also pay the amount of principal by way of interest. So computing whether you're capable to pay the EMIs also. So for that, we have debt service coverage ratio. So debt service coverage ratio is earnings available for debt service upon interest plus principal installment due. Earnings available for debt service upon interest plus principal installment due. Right? That's your debt service coverage ratio. Earnings available for debt service upon interest plus principal installment due. Now, what do we really mean by earnings available for debt service? Now remember, earnings available for debt service cannot be your profit before interest and tax or EBIT, because we are going to talk of in the form of cash. Okay. So earnings available for debt services, we say PAT, but wait, we are going to see whether we are able to pay interest or not. So if you want to check whether you're able to pay interest or not, I have to take a figure which is before interest. So I need to add back the interest over there. So PAT plus interest, plus we also add back the depreciation, because depreciation is not something which you are going to pay it in cash. So I just add back that depreciation. So we'll say depreciation and non-cash expenses. And then also we are going to add any non-recurring expense and also subtract any non-recurring income. So earnings available for debt service will be PAT plus interest plus depreciation and non-cash expense plus any non-recurring expense minus any non-recurring income. Okay, so that is going to provide us with earnings available for debt service number. So earnings which are available for debt service is going to be PAT plus interest plus depreciation, amortization and non-cash expense plus non-recurring expenses minus non-recurring income. Okay. Now, of course, higher this number, the better is the situation, right? Higher is the number, better is the situation. Well, why are we taking this as PAT? Because we have to anyways pay the tax, right? So we should look at the after-tax figures, and this is going to be something that's essential. Now, a simple, easier way, just to calculate the capability to pay the obligation, we calculate fixed charges coverage ratio. Fixed charges coverage ratio is EBIT plus depreciation, EBIT plus depreciation upon interest plus repayment of loan, which is a principal repayment of loan. Okay. So EBIT plus depreciation upon interest plus repayment of loan, that's going to be the fixed charges coverage. This is a quick way to calculate your capability to pay the debt. This is going to be the quick capability for paying the debt. Okay, so these are the debt service coverage ratios, guys. Okay. Are we good till now? Now, suppose if I tell you, yeah, EBIT is 3 lakh. Okay. And interest is 1 lakh. Depreciation is, let's say, 43,000. Okay. And we have the fixed charges coverage ratio. Fixed charges coverage ratio is 5. Sorry, not 5. Fixed charges coverage ratio is 3, guys. Can you just calculate the amount of repayment of loan? Yeah. So we have the fixed charges coverage ratio as 3, which will be equal to EBIT of 3 lakh plus a depreciation of 43,000 upon interest of 1 lakh plus the principal. So we can solve this as 3 lakh plus 3P is equal to 3 lakh plus 43,000. That's 3 lakh 43,000. 3P is equal to 3 lakh 43,000 minus 3 lakh. So the principal value is 43,000 divided by 3. So is the principal 14,333? Yeah. So the principal is 14,333. Right, guys? $43,000. How come? Fixed charges coverage ratio is 3 equal to 3 lakh plus depreciation upon 1 lakh plus the principal. Right? That's not. So interest of 1 lakh plus repayment of loan. The principal repayment of loan is basically principal, which I've taken it as P. So when we solve it, we're getting it as 14,333. Yeah. Okay. So now let us take a few MCQs, guys. Okay. Let me just share certain MCQ questions with you to solve. Sorry. Oh, my bad. Okay. Okay, come to question number 1, guys. So I've got the balance sheet extracts, and we are supposed to calculate the current ratio and quick ratio. So what's your answer for this, guys? Question number 1. Which is the correct option? Quick ratio, current ratio, and quick ratio, guys. So question 1, which is the correct option? So you have the current assets as 4,80,000 plus 3,60,000 plus 1,20,000, right? And the prepaid expenses was 40,000. So the total is 6,76,000 and the liability is 5 lakh. So the ratio is 676 divided by 5 lakh. So current ratio is what? One second, this is what? 4,80,000 plus 3,60,000. Okay. Yeah, so current ratio is 2 and the quick ratio is 9,60,000 divided by 5 lakh, which is 1.92. Yeah. Prepaid expense needs to be subtracted. So one second, there's a quick ratio of, okay, inventory also needs to be subtracted like this. So over here, the quick ratio, I mean, that's going to be 10 lakh minus 40,000, further subtracting an inventory of 4,80,000 and then divide it by current liability of 5 lakh. One second, what's wrong with this? So we have 3,60,000 plus 1,20,000. So 4,80,000 out of this. So of course, this is having a 0.96. So one can be counted over here. So option B is correct one. Same way, question number 2, calculate the return on capital employed, guys. Calculate return on capital employed. Yep. So over here we have a PAT of 12 lakh. We divided by 0.7 to make it PBT. And then we add to it interest of 3 lakh. That makes this number as the EBIT. And our total capital employed is equity share capital of 20 lakh, 10 lakh of reserves and surplus, and 15 lakh of debentures. So the rate of return is approximately what? I think, one second. This is profit after tax. We make it a income tax rate as 30% to make it PBT. Have this as 20% and 0.4476, which is 44.76 will be the return on, I mean, that will be the return on capital employed, right? So here we don't have this option. I think there is a mistake over here. So assume capital employed to be equity share capital plus reserves plus debentures. So you have taken all of them. And since this is the case, so return on capital employed is something, let me make this as option maybe 44.76%. Yeah, so option B, C is going to be the correct one. Fine. So with that, we'll do more of the MCQs and more of questions in the upcoming sessions. With that, let's just stop here for the day, guys. See you on Saturday, because on Saturday we'll be taking up more of ratios and the questions that we're going to look at. Okay, so let's just stop here for the day, guys. Take care. Bye-bye, guys. Yes, Astha. Astha, something? I think you're not audible. Your mic is not working, or I don't think your mic is not working, Astha. Anyways, we'll discuss about it later on, maybe. Maybe next time you can join from some other device, Astha, then we can look at it. Okay. Fine. Let's just stop here, guys. See you in the Saturday session, guys. Okay. Bye-bye. Take care. Good night, guys. Done.